Hello everyone, this is explanation of the homework problems and the answers that you should have gotten for the beautiful balance sheet. And this kind of looks at several things, including what we've talked about in this last week, but also kind of pulling in some things that we covered in earlier weeks as well. But the idea is that you're going to make any adjustments you need to the balance sheet. We're going to adjust anything that's available to fair market value as stated in the instructions, and use those present value concepts we've talked about in the last couple of weeks as well. So as we go down the balance sheet, cash is always listed at what the value is, the cost. There's almost never an adjustment there. Accounts receivable recorded at its net realizable value. So present value concepts or fair value usually do not apply to normal accounts receivable. They turn over too quickly to need to worry about interest or any of that sort of thing. But we get to a note receivable, and that starts to, we noted that we talked about that in an earlier podcast. Notes receivable need to be recorded at fair value if there is an impairment or if there is no interest involved. And so we gave you this explanation that there was interest, no interest involved, three payments of $300,000 each February received on 2/1. So you can see on the balance sheet they recorded it for just the face value, three payments, $300,000, $900,000. But this no interest says, can't do that. We got to use the present value of the three payments of $300,000. When we do that, we come over here, and in orange we have the present value of three payments at 7%. That's the normal rate. That's the rate that we borrow at down a little further down the problem. Is $787,294, and we've got interest for the year, because you would calculate interest, should have calculated interest for the year. Even though there was no interest, we calculated at the normal rate of 7%. So the total between those two is $837,000. We're going to debit the interest receivable, record that $50,000. We're going to credit interest revenue, and then we're going to change the rest from revenue to a note receivable, or credit the note receivable and debit revenue, because what we recorded is $900,000 of revenue, and you can't record that much. You can only record the actual present value of the future cash flows, which would have been the difference, if you will, the 787 compared to the 900,000. So we recorded too much revenue. This will reduce the revenue and reduce the note receivable to its fair value as it should be. All right. Building being used for normal operations, we learned that if, as long as you're using it normally, you do not need to test for impairment on property, plant, and equipment. However, there is construction going on as well. This is a self-constructed assets. We need to consider the addition of capitalized interest. The weighted average expenditures, 375, calculated for us. We don't have to do any 4/12, 5/12, or any of the weighted average calculations. We just need to look at the specific particular borrowings that were made. And if we go down here to the line of credit, it was for construction, $300,000. So the first $300,000 of our weighted average expenditures is at 7%. The other $75,000 would be at the weighted average of the other loans. Between we have a 6% and a 5.5%. So weighted average would be between those two. So our interest on the $300,000 at 7% is $21,000, and at the weighted average of 5.75%, the other $75,000 is $4,312. 50 we're going to then debit the building with the capitalized interest and credit. Typically our journal entry is to interest expense, because that's where, when we paid the interest, we recorded it. So the building is no longer construction in process. We finished it, so we actually listed as a new building on our new balance sheet at the original $600,000 plus the extra $25,000 in interest, capitalized interest. Equipment, no change in use, so we don't need to worry about that. We continue to use the depreciated cost. Idle equipment, the definition idle means it's not working, therefore its use has changed. We get a quote. We now have to compare it, look at it for impairment. We do so. We find out that we could sell it for $82,000. The original cost was $450,000. It's currently carrying value is $107,000. So the difference between 82 and 107 is recorded as a loss. We're going to debit loss and credit the equipment, or we could credit accumulated depreciation. Either way, but their equipment on the balance sheet is going to be $82,000, that fair market value. Broadcast license. This is an amortizable intangible asset, has 10-year remaining useful life. There have been changes to how we use it because of the changes in the broadcast spectrum, so we have to look at it for impairment because of those changes. The way that we look at the value of this is that it saves us on having to pay royalties, and the royalties would be paid on $2.1 million per year. The royalties are 6%. We would have to pay if we did not have this license. So the value, the future cash flows is 6% times 2.1 million. That's $126,000 a year. 10 years, that's 1.26 million. So it is impaired because this 1.26 million is less than the $1.4 million that is our carrying amount. So then we have to calculate the present value of these future cash flows to get our actual fair value. And when we do that, we do the present value at 7%, 10 periods, for the $126,000, that's only about just under $900,000, making our loss over $500,000. We credit the license and debit the loss to get it down to its fair value. Broadcast license then just under $885,000. There's your total assets, all right, so far. So we go down here, accounts payable. Like accounts receivable is too short term to worry about interest. Recorded at a cost almost every time. Line of credit, we do not have to make any change. We can assume that this interest rate of 7% is an appropriate interest rate, and therefore that line of credit is not necessarily needed. No adjustment to that needed. Except that I think we've, let me see. We assume that it was finished and paid off, I guess, for the interest rate. All we need is for that is for the interest rate, 7%. So it does not go on the balance sheet. But we have these two notes payable, and we're going to take all of them to their fair value. And so this loan, $500,000, we first borrowed on January 1st. Monthly payments for 15 years of 6%. So right now we owe $460. That's a carrying amount. We're going to take the present value of the future cash flows. We use 7%. Notice that's different than the original 6%. There were originally 180 payments. We've made 36 payments. All right, so that is how we get the number of payments left, and then this is the payment amount. And we notice that the fair value, or the present value, is 410, not the 460. And that's all because the interest rate in the marketplace has changed. And so because of that interest rate going down, we have to we debit note payable and credit gain. Now this is a choice. The company would choose to mark all of their payables to fair market value. None of the assets up here that we did the fair value were a choice. All of them were required. Each of them were brought about because of some impairment. But these two liabilities are a choice, and they have chosen to do so. That's what it says in the instructions. And so they figured out this one got the gain, and then they look at this other one. Okay, this is interest only payments. So instead of a monthly payment that's principal and interest, this is interest only. So we can calculate the interest based on a 5.5% of 500,000. And you can see the formula we used to get the present value. In this case, it was semi-annually payments. So we divide by 2, and then we have the number of payments left. And then at the end, there is a 500,000 face value. All the principal is due at the end. So we take the present value of that, we get 436, and the difference is our gain on that loan. So we're going to again reduce the amount of the note payable down to its fair value and the bond payable. There's our total liabilities, paid in capital, retained earnings, and this is our changes based on our journal entries to retained earnings. So this was the retained earnings in our old scenario before we made our corrections, and here are all the corrections we made based on our journal entries, and the old new retained earnings after all those corrections matches here, and our balance sheet balances as we would hope. And then the only thing we have still needed is we need to sell the equipment, all right, or a trade-in. So just a review of a trade-in scenario. Credit the old equipment, that's what we paid for it. Debit the accumulated depreciation that we had already recorded, okay? And this is assuming that we'd already reduced it to 92,000 from our earlier journal entry. We sell it for, we get some new equipment for 105. We pay cash of 10, so the credit there to cash. And you would normally make the journal entry balance with a $13,000 gain, but because there is no commercial substance, as we reviewed earlier, then you do not record the gain. So crossing that gain out, we still need to make our journal entry balance, all right? And so we're going to change the new equipment from a 105 down to 92,000 to get rid of the 13,000. So I put in red here an alternative way. If you had recorded the original loss on this equipment to accumulated depreciation, you would have a little different scenario. But this is the way that you would reduce the new equipment, instead of 105, the sticker price, down to 92 to get rid of this gain, because you can't record that. That's how you adjust your journal entry to deal with a scenario where there's no commercial substance.